Let's get started with our last exercise problem within Chapter 5 and see what information has been given to us and what we've been asked to do. So in problem 5-4a, we're told that Mary Wills is the advertising manager of a bargain shoe store. She is currently working on a major promotional campaign. Her idea includes the installation of a new lighting system and increased display space that will add $24,000 in fixed cost to the $270,000 currently spent. In addition, Mary is proposing a 5% decrease from 40 to 38 in the selling price, and she thinks this is going to produce a 20% increase in sales volume. From 20,000 to 24,000, it's going to jump. Variable cost will remain at $24 per pair of shoes. Management is impressed with Mary's idea but is concerned about the effects that the changes will have on break-even point and the margin of safety. They've asked us to compute the break-even point in units and compare it to the break-even point if Mary's ideas are used. They've asked us to compute the margin of safety for the current operations and after the changes are made, that is if we do it. And they've also told us to prepare a cost volume profit income statement for the current operations and if Mary's suggestions are incorporated. And finally, they're asking us for our opinion, should they do it or not. So let's take a look at my Excel spreadsheet and see how we would set it up. So let me make a quick adjustment here. So the selling price per unit right now is $40. What has Mary suggested? She suggested we should drop it to $38. I know most management, in most cases, management is not happy with it, but let's see what happens here. Then she has said that the variable cost at $24 per unit, the current number is going to stay the same. So we already know what's going to happen to our contribution margin. It's going to decrease because the selling price has decreased. From 16, it's going to drop to 14. My fixed cost currently is $270,000. Her proposal includes another $24,000. That's going to make it go up to $294,000. The sales volume currently is $20,000, and Mary says if we follow through with her proposal, that's going to increase to $24,000. I'm sorry, 24,000 units. That's how many units we're going to sell. Okay, so this is what we have currently, and this is her proposal. So we have to calculate the break-even point in units, break-even point in dollar, and margin of safety, both current and proposed. So let's write down our formula for each of these. Okay, contribution margin is, break-even point is in units is calculated as fixed cost divided by contribution margin per unit. Break-even point in dollars is calculated as the fixed cost divided by contribution margin ratio or the break-even point in units times selling price per unit. Margin of safety is calculated as actual minus the break-even point in dollars. So let's start over here. Fixed cost is $270,000 divided by 16. So these are the numbers we're concerned with. I'm going to highlight all of these over here for us. So my break-even point in units, 270,000 divided by 16 gives me 16,875. If I go with the proposal, I need to sell 21,000 units in order to break even. That's a little scary. I need to sell more. The break-even point in dollars, is 16,875 multiplied by selling price per unit, and we are looking at the break-even point was 16,875 multiplied by the selling price is 40. So let me just confirm that I have the correct formula in place. It's going to be G4 times B5, and that's what I have over here. Okay, and what would it be over here? It's going to be 21,000 times 38. Okay, I need to sell more at a smaller price. Don't know about you, but this doesn't look attractive to me at all. Margin of safety is the sales minus the break-even point in sales. So I'm going to, before doing that, set up my income statement. And again, I'm doing this as current and proposed. My sales currently is going to be 800,000. That's $40 for each pair of shoes times 20,000 shoes that I sell, pairs that I sell. Variable cost is 24 times 20,000. That gives me 480,000, leaving me with a contribution margin of 320,000. My fixed costs are 270, leaving me with a net income of 50,000. Let's see what the proposal does. I'm going to sell 24,000 units at $38 a piece. That's going to give me 912,000. If I just look at the sales number, it's very exciting. Let's see what else happens over here. Obviously, my variable cost goes up because I'm selling more units. My contribution margin is 336. Even that looks good. However, what happens to my fixed cost? My fixed cost has increased from 270 to 294. So what happens to my net income number? Ooh, it was dropped. Definitely not a good sign. Let's do this margin of safety calculation. Margin of safety calculation right now is $125,000, which means my sales could drop by $125,000 and I'd still be okay. I won't lose money. In the proposed plan, it drops to 114. That margin of safety, that cushion has decreased, and that's not good. So the final question is a real management question. What do you suggest? My answer would be no. We don't go with this proposal. I'm going to make less money. My profitability, overall bottom line is going to decrease. So although my sales number increases, my net income is decreasing. Therefore, if I were management, I would reject Mary Walsh's proposal. So I hope you get a good sense in this chapter how, as we have built on various exercises, that ultimately the goal is this is managerial accounting. You're using accounting to make managerial decisions. A really good company, good management will not make major business decisions without consulting with your accountant, without asking, what's it going to do to my bottom line number? In order to see what it's going to do to your bottom line number, you have to do a lot of what if analysis, which is exactly what we did over here. So good luck with the assignments.